Go ahead and get started. My name is Brad Renard. I'm Chief Investment Officer at QTR Capital. Also, I'm Chief Publisher at Upside Options. And I'll give you an update on the market, Q4 projections, a review of the stock methodologies that we use here at QTR Capital. And they're doing well. They continue to beat the market. So, also, if you need me, because I don't see my chat window here, not exactly sure why, but if you need me, just go ahead and knock because I can hear the knocking. So we're going to answer the following questions and cover the following topics. How do the major index charts look? And sector ETFs, and what are they telling us? What are the breadth indicators telling us? Will the major indices retest the June lows and find support, or will we be taking out lower lows? What is the probability that the market finds a bottom in October or November? We'll talk about how to construct a 25-25-25-25 portfolio, mixing active and passive investments, and that can handle most markets. How to measure the risk-reward trade-off of an investment. We'll show that on some of the charts. What's the price action of Apple, Microsoft, Google doing, and also the high flyers, or used to be high flyers like the Pelotons, DocuSigns, and Teladocs of the world. Our stocks trading under the surface of the major indexes. So we'll cover that. What are the economic indicators telling us? How do corporate earnings look, and what are the analysts projecting for the next 4 quarters? How expensive is the market? Do we see a recession coming? Should I sell some of my passive ETFs? Should I add some short exposure? Should I buy bond funds? What's better right now? Value, growth, small, large, mids. We'll cover that. Which sector ETFs and stocks are the best to rotate into right now? Industrials, healthcare, financials, energy. Will be the best investment style for the end of this year and early 2023. We'll talk about that. What can an option selling strategy like Pinnacle work? That's one of our strategies that's in Upside Options. We'll talk about that. And then review of the methodology that we use at QTR Capital, and that's for equity strategy. That's for equities. All right, 1 second. Let me just make sure that everyone has entered. Bio on me. I'm CIO at Chief Investment Officer at QTR Capital. That's a registered firm. I'm Chief Publisher at Upside Options. That is a newsletter. I've been doing that since 2004. I'm an adjunct professor. I teach at Chapman University. That's here in Orange County. I'm in Southern California. In Palomar College, I teach statistics, econometrics, and analytics. I've been in high tech for 20 plus years. I've been out of high tech now for the last 7. I started as an electrical engineer, GE Space Division. I was up in New Jersey. I was in marketing, sales, different roles in sales and marketing. I co-founded a company. My primary industry was chip design software. Cadence Design Systems is a chip design software company. So all the semiconductor designers will use that software to design semiconductors. I was also in Japan for a couple of years running one of those branch offices. My education is in physics, electrical engineering, Columbia, and MBA Chicago booth. We have a large cap for QTR Capital. Let me just cover 2 or 3 slides on kind of about the firm, and then I'll get into the charts. Large cap, greater than 10 billion. We have a small and mid cap that's 250 million to 10 billion. We have a global sector rotation ETF. That one basically is rotating around and moving into strong sectors within 90 industry sectors around country ETFs and around the world. Iron Condor Pinnacle, that's Iron Condors and credit spreads selling index options. Dividend Income Plus, and this one is kind of a bond replacement. So it buys a basket of blue chip dividend paying stocks. We basically collar the stock, so we can't participate in the upside, but we can protect a lot of the downside. And then we just focus in on the dividends, and we're extracting out the dividends. And then we lever it up also. So by levering it up, we take it up to about 20% dividend payments, and then we use a lot of that cash to buy hedges, and then we get it. It comes down to about 8, 9, 10% annual. So instead of collecting bond payments, instead of debt, this one focuses on dividends. So it's a different way of getting an 8, 9% income stream. Here are our results for 2021. Large cap 27%, small, mid 28, global technical rotation. Contrarian was kind of a 15-month play. After COVID crashed the markets, we turned this one on and we figured we'd get 40, 50, 60% in about 15 months, and we did. We got 40%. Pinnacle, this one got hit hard. We can talk more about it if anyone's interested in index credit spreads. All markets aren't good for all strategies. So periodically, some certain strategies won't work in certain markets, and COVID created a lot of dislocations. Dividend income plus was 8.5%. And then for 2022, we'll show some charts below. This is large cap. This is value of $1,000, started at the beginning of 2019, and comparing the fund versus the benchmark. In this case, the benchmark is the S&P 500 index. One goal of a portfolio manager is to continue to beat the index. That's the goal. So you can beat the index, but you have to beat it at lower risk. So we'll talk a lot about that. And then alpha is the difference between the return of the fund versus the return of the benchmark, and that's alpha. So in general, we've had positive alpha going back to March 2020. And we had a lot of alpha there. Unfortunately, we gave some of it back, but that's just the way it goes. It ebbs and flows. And then risk needs to be looked at, because someone can make you a lot of return, but if it's a lot of risk, then you have to take that into account. So risk is defined as how much a portfolio fluctuates and how much it draws down compared to the benchmark index. So in this case, this really summarizes a portfolio right here. Summarizes an investment strategy. Tells you how much risk down here, and it's measured in standard deviation, basically how much the portfolio fluctuates from week to week, month to month. And we're looking at the fund versus the benchmark. So this is the S&P 500 index here, this orange dot, and the fund is the blue dot. And the fund is our large cap in this case. And it says that in this date range, basically since inception, the fund has generated greater than 75% returns at this risk level. And then the benchmark has generated this much return, a little lower, at a higher risk level. So this is a very, very important chart, and it's in the 2-page fact sheet. This is one other way of looking at the return of a fund. So any investment that is offered to you, and you should always ask for a 2-page fact sheet. Kind of looks like, well, this thing here has a 2-page fact sheet. And that has these charts in it. And this is one of them. And since inception, usually you care about kind of the 2-year, 3-year, 4-year, 5-year. And since inception, it shows that we've generated, this was as of August 16th, this strategy has generated 76% gain versus a 59% gain for the benchmark. Okay. Year to date, we're about 7 points under the benchmark, or better than a benchmark. Benchmark right now, at least on the 16th, we're sitting about a minus 10%, and we were at about a minus 5.6%. So we had a lower year-to-date drawdown. And right now we're sitting at like a minus 8 or minus 9, and the benchmark sitting at a minus 15, something like that, minus 14. So everything boils down to risk-adjusted returns that are shown on the 2-page fact sheet. If anyone ever offers you an investment, just ask for a 2-page fact sheet. And if they don't have one, then that's kind of a red flag. So an investment strategy comprises style, methodology, entry rules, and exit rules. So I'll repeat, an investment strategy comprises style. Ours is active management for QTR Capital. And a methodology. Ours is quantamental. So we do fundamentals, technicals, and quant, all three. And then those translate to entry rules and exit rules. And then those entry rules, exit rules give you the results, whatever you're trading. We trade about 27 stocks per portfolio. So we're basically stock pickers. Then that information gets fed into the fact sheet. Okay, on the topic of portfolio allocation, I bring this up because this has come up a lot with clients, and I see clients kind of over allocating in certain areas. So I just wanted to cover this and just kind of throw it as food for thought. A recommended portfolio is to allocate across 4 investments. Sometimes you can do 5, sometimes you can do 3. Basically, this one shows 25, 25, 25, 25 for a total portfolio, 25% in passive equity strategies, 25% in active equity strategies, 25% in fixed income bond equivalents, cash, gold, silver, platinum, art, collector cars, and real estate. Okay, back to the passive. This is, for example, buying index ETFs, such as the SPY, that's the S&P 500 index, or the IWM, that's the Russell 2000 small cap index. I've seen too many people allocate way too much in this, and it's just dangerous. And my next slide will say why. It's okay. It's okay to allocate some to the SPY and some to the IWM and other indexes. But our recommendation, most financial advisor recommendations, are to split it up, break it up, and make sure that there's kind of try to get low correlation between each of these quadrants. So one option is 25% in passive, and you can buy and hold. You can dollar cost average. You can buy if you have some dry powder and you think that the market might be bottoming, and you just buy and hold. You don't trade it. Active now is completely the opposite. This is traded, and this is what we do. QTR Capital, for example, a large cap alpha could be an option there. And we follow well-defined entry rules and exit rules. So these are completely different, and they have low correlation with each other. And then down here, now a lot of this has been on hold, by the way, like AGG, TLT. These are typical bond ETFs you could buy, but they've been on hold. The Fed started raising rates at the beginning of the year, and you just cannot be in bonds. And you can't be in bonds until the Fed is done raising rates, and that should be in a couple of months. But you can put all kinds of things over here to diversify, and then real estate, for example, single family homes. And this one also, I believe it should be on hold for the next 1 to 2 years. We just went through a bubble. So it's never good to chase. You just don't want to chase anything, whether it's stocks or real estate or bonds, anything. So it's not good to chase it. Okay, so we're basically allocating, it's recommended to allocate across multiple investment classes with low correlation with each other. That's the key. Low correlation with each other. Recommended to keep the passive component, that's this one over here, under 30% of total portfolio. And here's why. Well, in 1929 through 1940, that was the Great Depression, investors lost pretty much all their money. You were rich, and now you are poor and standing in a breadline. Let's hope it doesn't happen again. But at that time, the Fed and the president and Congress, they did all of the wrong things, and everyone lost their money. During the Great Financial Crisis, GFC, there's an actual real acronym for it. The Great Financial Crisis that started in 2007, many investors lost a lot of money, 40, 50%, just depends on what they had. I have some personal friends that lost a lot of money during that time because they just couldn't hold on long enough, and it's just too stressful. You just lose too much sleep. It just kind of damages everything, and it's a disaster. One last thing, what I don't like is the Fed's tools are running out of effectiveness. So in the past, they could just lower interest rates. Now, ever since 2007, 8, 9, the great financial crisis, they had to turn on quantitative easing. and it's building a house of cards. I don't like it. So we believe that recessions will or could start getting deeper. They could last longer, and the negative reactions to the stock market could get more violent. Meaning, you want to protect yourself. Do not trust anything. Over here, you're trusting everything. You're basically trusting what the Fed does, what Congress does, what the president does, what the world does, and you can put some of your money into that. And in the last 10 years, 15 years, it's been doing really well. It has. But just it's recommended just to try to keep this below 30% if possible. That'd be the best, because we don't like this. When we say quantitative easing, what that really means is that the federal government borrows money continuously through issuing bonds, treasuries, and then the Fed turns on their printing presses and prints money to buy those bonds. And that's not sustainable. And then the Fed keeps on getting into the problem because they can't unwind their balance sheet because we end up having the next disaster too quickly and their balance sheet stays up higher, higher. We're sitting at $9 trillion worth of bonds that they bought. Kind of reminds me of the dot-com craziness in 1998, 99. And I was in that. I was in Silicon Valley running around selling software to dot-com companies. And after a while, you're like, this is not sustainable. Per the active equity strategies, like over here, just make sure the portfolio manager follows well-defined exit rules to protect capital. Well-defined exit rules. And sometimes they won't share too much with you because that's their proprietary secret sauce, but just ask them, do you have well-defined exit rules to protect my capital? And if they can't answer that question, then I would not work with them. Meaning things could draw down. They let positions draw down, and then before you know it, they're down 30% on a position. Now they're down 50% on a position. Now they can be down more on a position, and it can last a lot longer than you think. So we just don't like doing that. Okay, so that covers kind of the basis of QTR Capital, a little bit on our methodology and style, and a recommendation on how to allocate a portfolio. Okay, any questions right now? And if you do, just go ahead and let's see, I do see a few questions. Why the hold on the real estate for the next 1 to 2 years? I sell a bubble. When I see a bubble and I see something going parabolic, that's not sustainable. And also interest rates are rising now, and mortgage rates will probably, they could get up to 6%. That will slow things down. I mean, you don't necessarily have to wait that long, but I've just seen too many bubbles over the years. And I've seen too many parabolic moves in charts. I don't care if it's real estate. I don't care if it's collector cars. I don't care if it's stocks. When you see a parabolic move, and that we've seen that recently, it tells me pause. Just pause for a year, at least a year, and see what happens. And every zip code's different. I mean, I have experience in real estate in Arizona, and I went through that and bought homes and condos, and so I do have experience in that. And at that time, I did buy low. Things were pretty beat up, and so I started picking up homes and picking up condos. And then I started seeing things get really frothy. I started seeing a lot of parabolic moves and things. Now, I don't know. I don't know how long it's going to run. No one does. But I ended up selling at the top for a few homes when it was a seller's market, and that sure was nice. That was really nice. I didn't have to do anything. Didn't even have to let them inspect the house. Nothing. They would just pretty much it was nice, and so that was good timing. But hey, I would say that was lucky. It's being lucky too. It's just I'm a chart reader, and when I see things starting to go parabolic, it just tells me that things aren't sustainable. And I'll show you a parabolic chart on the stocks. All right, so just pause, a pause for months, if not a year and a half, just to see how the higher mortgage rates impact the real estate market. And if you start seeing just too many people showing up and wanting to buy stuff, that's when I usually pause personally for me. Okay, back to equities. What this is earnings, forward 4-quarter projected earnings. The analysts do all this work. I use FactSet, and the earnings got crushed after COVID. And this is we're using this y-axis over here. So earnings is $140 of projected earnings for the 500 S&P 500 companies sitting in the index for the next 4 quarters. And then we had lots of fiscal stimulus, and we pushed the stock market up, earnings up, which pushed the stock market up. So we had $4.5 trillion worth of fiscal stimulus, COVID fiscal stimulus, which we've never seen before. That was unprecedented. That overstimulated the market, overstimulated the economy. So everyone had money. Everyone was sitting on their couch with their brand new laptops, and they were buying stuff on Amazon. All right, earnings are finally starting to taper off a little bit, but they're still reasonably strong. They're not that bad. And then this blue is the S&P 500 index, and that is this over here on this y-axis here. So companies are lean and mean. They've learned how to generate earnings even in tougher situations. Not to say this was tougher. I mean, yeah, COVID was tough, and it was tough actually for manufacturers, but there was plenty of demand because we had lots of checks coming into our mailbox from the federal government. Earnings were hit hard from COVID. That was here. Went down to 140 bucks worth of earnings. Now we're up to 230-ish. S&P 500 companies grew earnings by 50% to 220 bucks in 2021. So that was pretty much when the COVID stuff was still happening, the fiscal stimulus. That was juiced by the 4.5 trillion of stimulus. Market's trading currently at 17 times earnings. We're at around 4,000, so we're okay. We're not expensive right now. Market is classified as fairly valued. Earnings are projected to grow forward 4 quarters by 4%, 4.5%. So, boy, that tells me that, things are okay. Companies are still doing okay. Let's look at the charts, indexes. Here's the S&P 500 index. So for the daily charts, you're going to see the same type of chart. I show the 13 moving average, which is the red. I show a 50 moving average, which is the blue. These are EMAs, exponential moving averages. Then I show the 200-day moving average, which is black. That's an SMA, simple moving average. And I show 150-day SMA. And we just had a textbook rally, kind of a bear market rally. We took out a lower low for the S&P 500. Your eye should always be looking for, am I taking out lower lows or higher highs? This is daily, goes back to July of 2021. We can see that the 200-day is rolling over. It's downward sloping, so that's bearish. We can see that we took out a lower low way down here, 36.40. Bounced hard, went up and hit the 200-day line, sold off. That's textbook right there. That's textbook bearish action. And anyone knows what they're doing in this business, they're buying puts right here if they have hedges in their portfolio, if they're putting any type of bearish trades in their portfolio. That's a very high probability trade right there. Okay, so that's an S&P 500. It's still a bearish chart, but we're going to be bottoming soon. Here's the S&P 500. This is a weekly chart. So the weeklies, I always show the 17 EMA, 17-week exponential moving average in red, 43 exponential moving average in green. Whenever the 17 is above the 43, it tells you we're in a long-term confirmed uptrend. Whenever it's below it, tells you we are in a long-term confirmed downtrend. So still a bearish chart. Everyone's trying to figure out, are we going to retest this 3640? Or are we going lower, coming down here, which would be a full path, down to the pre-COVID high. Okay. So this, again, this would be called a round trip. So we'd do a full round trip back down to this pre-COVID high of 33.88. Because here's the pre-COVID, crashed, started getting choppy right here, and then the market basically started going up, saying, hey, we're going to have a lot of fiscal stimulus. And then the market rallied strongly. NASDAQ Composite kind of looks the same. Didn't even touch the 200 actually. That's a little more bearish there. This one has a lot of high tech stocks in it. NASDAQ Composite Weekly. By the way, I'm recording this, so this will be on our website. So you can see this again if you want. Here's the weekly, goes back to 2018. Here's the COVID breakout right here. Climbed a lot. This is just crazy. This is unsustainable. I can show you 400, 300 charts that look like this, stocks, just individual stocks that look like this. It was just, I've never seen anything like it other than 1999. And we know what happened in 1999. That was the end of it. July of 2000 was kind of the beginning of that was the beginning of the bear market and the recession, and all the dot-coms blew up. All right, 17's below the 43, and good chance we'll find a bottom here, probably. Here's the mid caps, looks the same. This is the daily. 200-day moving average is downward sloping, came up, hit the 200, actually overextended over the 200, sold off. Small caps, same thing. IWM. So, reasonable chance we're going to come down and retest some of these lows, especially for the small caps. Smalls will usually retest and possibly even take out a lower low. Okay, so here's the NASDAQ Composite. Here's your parabolic chart. This is a monthly chart. It goes back to 1999, so it shows kind of the 1999, 98, 99, 2000 parabolic move. We know what happened after that. This is the dot-com crash, pretty long recession. It took 7 years for that to come back a little bit. Actually, for the SPY, it took 7 years for that to come back. Now, for the high-tech companies in the NASDAQ Composite, it took a long time, like a decade, for that to come back, or longer. This right here is parabolic. Sooner or later, that is not sustainable. But they can run for a while. So what traders will do is, as long as you're on the wave, you ride it and ride it and ride it. But the traders, will move really fast in trying to protect at least half of their gains. They don't want to give back more than half their gains. Here's the S&P 500 index. Here's back to 1998, 99, 2000. Kind of a slope here. And then it took 7 years for it to get back. But then we haven't. That was a 2007, 8, 9, 10, 11, 12. That was the great financial crisis right there. All right, we had the breakout. Huge move. Haven't seen anything quite like this. And now we're paying the piper. We have high inflation, so the Fed's stomping on the brakes. Volatility, high volatility. It's been all over the place. We're around 24, 5-ish. Here's a better picture. Here's volatility. This is VIX for volatility for the S&P 500 index. And this goes back to 2011. Look at this volatility here. This has been high, persistent volatility. We've never seen anything like this in a long time, at least 25 years, where it's just stayed persistently high. This has made it tough for me to trade options. I need stuff more like this down here. All these years was good for trading options, selling premium, bringing in premium. This is not right here. You can make it until your trades get hit, and then you're stuck. Market breadth. This is a good leading indicator. There are very few leading indicators. Just about everything is a lagging indicator. Market breadth this is advanced decline, cumulative advanced decline. So every day you take the advancers versus decliners for the S&P 500 index, all 500 stocks, how many declined versus how many advanced. You get a number, add it to the previous number. You just keep on adding it, and you get a cumulative advanced decline. You can see the S&P 500 has been very resilient, very, very resilient. And very different than the NASDAQ Composite. Here's the NASDAQ Composite cumulative advanced decline line. It started rolling over just about when we knew things were going to start rolling over. We've been telling our clients since October, November, December, start booking profits. Start booking profits incrementally. Take 10% here, take 20% there. start going to cash because we knew that the Fed was going to start raising rates. And this one is a very nice leading indicator. And still, it was going lower all the way down through July, August. Now it's probably going to bottom and double bottom here. So, because the Nasdaq Composite has been the leading edge of all of the declining stocks, because it has a lot of tech in it and a lot of small tech stocks that aren't making any money. Macro worldwide. Here's Europe. Everything looks the same. 200's downward sloping, 200's downward sloping. Everything's below the 200-day line. Everything is still kind of taking out lower lows. Europe's a mess with Ukraine, Russia, high energy prices. They're pretty much in a recession or will be in a recession. They just have to get through this energy mess that they're in. So Europe, here's Germany, here's emerging markets. We knew that the Fed was going to start raising rates. And when they do, the dollar will strengthen and that will hit emerging markets. So this is pretty much textbook here. China, that's been kind of a rough play with zero COVID policy, and then they were also tamping down on regulations. They were doing all kinds of regulatory crackdown on tons of different companies in China, and so that's been really hitting their stock market. And then world ex-US, you can see that we're still kind of bearish. Okay, why do we watch this? Because this stuff can impact the US. So you have to watch lots of charts around the world. And then sooner or later, something's going to wash up on our shores. So you need to watch markets around the world. All right, our sectors. These are all pretty much mostly US companies. This is XLF. So here's financials below the 200. Here's XLI industrials below the 200. Banks, KBE below the 200. Consumer discretionary, stuff that we don't really need, but we'll buy if we have lots of money. Pool tables, boats, eating out, things like that. So this one's still pretty bearish. Stocks, semiconductors. This has been one of the strongest spaces, and recently it's been rolling over. But these companies they still have pretty good earnings. IYT, transports, these all look the same. Everything looks the same. Here's RYT, this is equal weight tech. You want to look at equal weight because Microsoft, Apple, Google, Amazon are so big. They keep on yanking all the ETFs around and the indexes around. So I watch equal weight also. Here's RYT and still looks pretty bearish. XLE Energy. And we had a lot of energy. We made some good money on energy. It's pretty choppy though, but energy's still decent. Our weekly market analysis is here, qtrcapital.com/market analysis. You can just go to the website, qtrcapital.com, and you'll see a link to our market analysis that has about 50, 60 charts in it. Shows a lot of these charts. Every Sunday, this goes out. And it's free. You don't have to pay for it. Let me just see if I have any. Okay, just a question with regards to, I'll come back to the portfolio again. Cash is okay. Cash is a position. Cash sometimes is a good position to hold. It is okay to hold cash. When inflation is high, sure, it makes you feel uneasy to hold cash, but you have to look at the big picture and say, oh my gosh, if I actually held an investment with this cash, I could be losing my money. I could be down 10%, 15%, 20%. So it is okay, especially when I'm showing all charts and I'm showing a lot of bearish charts. You're like, where do I put my money? Well, maybe we stay in cash. And by the way, you can't even, like that bottom left quadrant of 25%, which is bond replacement, gold, platinum, silver, art, cars, collector cars. That one's on hold. So you do need to know how to read some charts to know when to get in on like gold or silver or platinum. Dollar's been climbing. It's been pushing down commodities. So it's just gold is not behaving like it used to. It made it even tougher to use as kind of a hedge. Used to be an inflation hedge. Doesn't seem to be that anymore. So cash for one or even two of those quadrants could be okay. Could be okay. All right, the mega caps. We always care about what's Microsoft doing, what's Google doing, Amazon, Apple. Are they hanging in there? Do they look healthy? Well, they were very healthy as long as they're over the 200-day line until recently. Now they're below the 200-day line. Earnings growth is still reasonable for these companies. I think Microsoft, I think they're all like plus 10% for next year. And that's a lot of growth for these huge companies. Apple, I think it's like plus 7, 8% for next year. Google, similar. But the chart is somewhat bearish. Anything's below the 200-day line, in general, nothing good can happen under the 200-day line. I repeat, nothing good ever happens under the 200-day line. When you're looking at the daily chart, now it has to be the daily chart with the 200-day line, SMA, simple moving average, and sometimes it's better just to be in cash versus being in a stock that's below the 200-day line. All right, stay-at-home stocks like sentiment. Everything went crazy. COVID, like here's Peloton, DocuSign, Teladoc, Square. Most of these stocks went up by 200, 300, 400%. I didn't even see this in 1999. I didn't. It was nuts. I was like, wow, never seen anything like this. And now they've all fully round tripped. And actually, they have taken out lower lows now. DocuSign actually hasn't yet, but I guess it's just Peloton took out a lower low. And Teladoc actually took out a lower low. So it gave it all back and then some. We needed this to first happen. Once this happens, that tells you the market's going to start unwinding. See, that has to happen first, and that happened a while back. All right, economic data. In general, the economy looks decent. And there's a lag, there's always a lag from a change of monetary policy to when it starts taking effect. It usually takes 3, 4, 5, 6 months. You know, the Fed raises rates by 75 basis points. Sometimes it doesn't do anything for 3, 4, or 5 months. So there's a long lag. Economic data, here's PCE core inflation. Just tells us inflation is just off the charts. Interest rates are climbing because the Fed's raising rates. But we have very low unemployment. And this is, it's perplexing. It's just crazy. I mean, you can say, oh yeah, we're in a recession because we just had 2 back-to-back quarters of negative GDP, but does it really feel like a recession? We have 3.6% unemployment. I think it's at 3.8 now. A typical recession means unemployment starts climbing. And will it? Well, it probably will, because the Fed has no choice. They got to get this down. This inflation is too crazy. And then here's our University of Michigan consumer sentiment. This is pretty crazy. The sentiment just tells us that we're back down to, you know, how unhappy people were back in 2008, 2009 because of inflation and trying to fill up their gas tank and paying their energy bills. So this will eventually impact us because people will slow down their spending when they're that unhappy. It just takes time. Payroll, we were still adding jobs, kind of 200, 300,000 jobs. People still adding, you know, making more and more of their jobs, and this was causing inflation. Unemployment rate is still very low. Manufacturing has been rolling over. About 15, 17% of our economy is manufacturing, and it's still expanding, still over 50. So it's still expanding, but it has been rolling over slowly. Non-defense capital goods, less aircraft. This is basically a proxy for business spending. Business spending. Our business is buying goods and services to to keep their businesses running. And they're still growing, they're still spending money. So businesses are spending. Consumer credit, this is credit cards and auto loans and business loans. So there's plenty of credit floating around. If there's credit out there, people will spend it. Retail sales, still positive. Here's our 10-2s yield curve, and it's been inverted. So you always hear about the inversion of the yield curve. So if this stays inverted for like extended period of time, it just increases the probability that we're going to have a recession. But I mean, the only thing to really look at is, hey, we still have low unemployment. Most people, if they want work, they can get it, but we have this high inflation. That is the problem. So you can almost like ignore everything else. So the interest rates are going up, Fed's raising rates, and that's impacting the stock market. All right, so this is the S&P 100. That's a daily chart, weekly chart. Okay, let's just go to the questions and topics, and then I can jump into the next section. Next section is our methodology. So how do the major index charts and sector ETFs look? What are they telling us? Well, everything is still bearish, but I think we're getting close to a bottom. So the bottom's either going to be the June low, or it's going to be a higher high. Like for the SPX, it's going to be either a kind of that 3640 level, June low, or it's going to be around a 3900, which is kind of where it's trying to find support right now. And I think the probability is pretty low that we're going to take out lower lows. But could we still take out lower lows? Yeah, we could. But we're starting to kind of, but putting a bottom in is a process. It's a process. It's not an event. It takes many, many months. So we're always kind of watching the process unfold, and then everything is probability. So what is the probability that we are bottoming and going through a process of bottoming? And so it usually takes many months, and then you're always trying to figure out, okay, I mean, am I ready to get in? Because you can get whipsawed right out if you're wrong. Right, so most of the index charts are still bearish, but we're starting to put a bottoming process in place, I believe. What are the breadth indicators telling us? Well, same thing. Bottoming process is coming, is happening slowly but surely. We have to get through September 21st. So September 21st, the Fed's going to raise rates again. Then we'll see how hawkish they sound. And then they raise rates again, and then we have two more hikes. One at the very end of December, just before Christmas. And the minute that everyone believes that the Fed might just only raise rates by 25 basis points, that right there that's the bottom. So we're getting close. Will the major indexes retest the June lows? Some of them probably will. Can we take out lower lows? Lower probability now. What's the probability that the market finds the bottom in October, November? It's increasing. How to construct a 25, 25, 25, 25 portfolio, mixing passive and active. We covered on that. How to measure risk reward trade-offs of an investment. I'll touch on that on the next charts that I show. What's the price action of the big guys versus the high flyers? I already showed that. The high flyers, they all round tripped, and that needed to happen first. The big guys they're doing okay. They all needed to do what they're doing. They're all kind of rolled over. They're all below the 200-day line. These companies are still growing. They're still growing plus 10%. What some people like to do is they're like, hey, I want to guess where the bottom is for Apple, and I'm going to buy. Well, you can, but however, you're below the 200-day line, so there is a lot more risk below the 200-day line. How are stocks trading under the surface? Not good. We follow 1,500 stocks pretty closely. These are all good companies with good earnings growth. Most of them are under the 200-day line. However, I believe we're starting to bottom. But the economic indicators telling us economy is decent, but it's going to start rolling over. It will. Every time we raise rates by 50 or 75 basis points, it will slow things down. And so the next rate hike, September 21st, will be a 50 or a 75 bips rate hike. It will be most likely 75. And everyone knows that. It's baked in. How do corporate earnings look and what are the analysts projecting? Not bad. Earnings are supposed to grow by plus 4.5% for the next 4 quarters. So companies have figured out how to continue to make money even when the Fed is raising rates. How expensive is this market? It's fairly valued at 17 times earnings right now. Now, it doesn't mean you can make money in stocks. You can get chopped up. Sometimes it's better if you don't have a very specific methodology, then sometimes it's better just to stay in cash. If you do have specific entry and exit rules, then you can trade this market and you can make some money. Do we see a recession coming? Probably. 2023, I think, I don't know. Again, what's the definition of a recession? I mean, unemployment really needs to be higher than 4%. It needs to be closer to 5, 6, 7% to really be a recession. We're not even close to that. Sell some of my passive ETFs and broad funds. Well, we've been telling people to sell a lot or sell some incrementally back in October, November, December. Anyone that would listen to us till we're blue in the face, please take something off the table. You were just given a gift. That was called that $4.5 trillion of COVID fiscal stimulus that just drove up everything up straight up. So if you're still holding everything, there's nothing wrong with always cutting a little bit of exposure, but some people are sitting on big drawdowns, and I would say cut a little bit of exposure, but you're kind of stuck with the rest. Should I add short exposure? If you're an experienced trader and you know how to hedge and you know how to open up short trades, then sure, go for it, but it's not easy. Should I buy bond funds? That's still on hold. We need the Fed to stop raising rates, and we need the market to believe that the Fed is getting close to stop raising rates. Once that happens, then you can start buying bonds again. What's better right now? Value, growth, small, mid, large. I'd stick with large. But you can't make a lot right now. You can make +5s, +7s, +10s, but you have to take your gains really fast. You have to pretty much trade this market. It's a stock picker's market. It's a trading market. Which sector ETFs and stocks are best to rotate into now? Healthcare, energy, but be careful with energy. But you can make some money in it still. Those energy companies are projected to grow a lot of earnings over the next year. But you can still get chopped up in all of these sectors. What will be the best investment style for the end of this year and early next year? Passives, actives. So definitely not passives until we believe we're at the bottom. So for that portfolio I showed you where maybe 25, 30% of your money is in passive, and if you have some dry powder, probably in October, November, you can start looking at it, or you can reach out to me and I can give you my thoughts, and you can read the analysis too that I do, and I get some help on it each week. And you can say, all right, I think I'm getting close to the bottom. So maybe I'll pick up some of the SPX. Maybe I'll pick up some of the NASDAQ composite. Let me see if we have any questions. Okay. We buy breakouts. That's what we do. So there's higher probability of us being right and being able to gain at least a +5, +10 in a choppy market. But it's a day job. I mean, you have to put 40 hours a week into it to do a good job in multiple portfolios doing what we do. Covered calls, they could work, and holdings that you have. Dividends, of course, are nice. Non-directional strategies, most of these tend to be options based, and volatility has just been too high. It's just kind of put a hold on all of those strategies right now. How well can an option selling strategy? I just said that's kind of what we do for credit spreads and iron condors. We sell on the indexes, and it's been on hold. Okay, so let's review the methodology. Well, back to large cap, just on the 2-page fact sheet is on the website, qtrcapital.com. And some of the things that, if anyone's ever recommending an investment to you, always ask for the 2-page fact sheet and then kind of dig into the 2-page fact sheet, figure out max drawdown. Does this investment get clobbered when the market gets clobbered? Ours is half as severe. The drawdown is half as severe, which is good. Up market capture. What that means is if the market's up 1%, how much is the fund or the strategy capturing? And we're capturing more, 150% of what the market's doing. Alpha means we're beating the market by 17 points. Beta, this is important. How correlated is our fund to the broad market? So the broad market correlation is 1.0, S&P 500 index. We're 0.74, and this is good. The lower the correlation, the better. And our small cap is like 0.51, means that we're stock picking and we have a much lower correlation to the broad market, and that's what you're looking for. Okay, we hold 27 positions. That's what the two-page fact sheet looks like. They're on qtrcapital.com fact sheets. Okay, the scanner, and then we're almost done here. So what do we do with our methodology? Our methodology is it's a 4-level scanner. We do macro analysis at the big picture levels, technicals, breadth. I showed you what some of the breadth charts we look at. We got about 20 that we look at. Cumulative advanced decline line is one of those. Technicals, what do the charts look like for the big picture, like for the weeklies and daily charts? Fundamentals, overall economy, basically, economic data, sentiment to modulate, and then overall sentiment. What's going on with like Microsoft and Apple and Google, and is money still flowing into the market? And that's sentiment, and that modulates your overall bullish and bearish exposure levels. So that's the macro analysis. Then we do a technical scan, and we're looking for high probability technical setups in stocks and ETFs. Then we do a fundamental scan. We're looking for strong or weak companies, mostly strong companies, because that's where we're going long. If we're going to short something, then we'll look for weak companies, but we haven't been doing that recently. Basically, we're just going long. We're looking for fundamentally strong companies, strong earnings growth. Then we do a quant screen. That's all probabilities. I'll show you a separate chart on that. And then technicals, they will trigger our entries and exits. All right. An investment strategy comprises style, methodology, entry rules, exit rules. So if you're ever talking to someone and they're kind of pitching you something, especially if it's equities, just ask them, what's your style? What's your methodology? What are your entry rules? What are your exit rules? Now, they're not going to answer everything, but you want to make sure they have rules, entry rules and exit rules. And for methodology, ours is quant, fundamentals, and technicals, all three. You'll see that a lot of shops only have 1 or 2 of those. We do all 3. Overall, our style is we don't like stuff drawing down. So we protect capital. So trying to keep those, if it's a losing position, we try to keep that losing position under 8% loss, and that's okay. We can handle that. Okay, the next technical scan. So we're looking for different types of setups, and I'm just kind of showing you a handful of setups. Here is Marshall McClellan. This is an insurance broker, well known, and you can see that after the COVID crash, banged up against this high of 119, up against 119 again, up against 119 again. Here's the weekly chart. Daily charts up here, weekly charts down here. Weekly chart says that the 17 is above the 43, so we're in a confirmed uptrend, long-term confirmed uptrend. And finally, we get a breakout. And this is a nice long consolidation pattern right here. This is like almost a year long. So you have to be very patient. That's why we watch almost 1,500 stocks, 1,450 stocks to be exact. And you have to watch them for a long time. And then here's the risk reward. The risk is the reward is you got a lot of reward, and the risk is very tight because you have this heavy duty breakout level here. And then you got a 200-day line right there, which is nice. So I can keep this risk pretty tight, and I got a lot of reward, potential reward. Doesn't mean I'm going to get it, but it's a lot of potential reward. So you're looking for this type of chart, this type of graph where the reward is greater than the risk. You always hear that from the talking heads, especially the portfolio managers that are being interviewed on TV, and they're always talking about the risk reward trade-off. This is what they're talking about. Here's Red Robin Gourmet. This is a different type of setup. We usually put these in our contrarian portfolio. So it got beat up from COVID. It's recovering. It's getting back over this 35.79 level. Then once we feel comfortable that it's going to stay above 35.79, we get in, and then we can make a profit kind of in this range from 36 bucks up to 65 bucks. So back to risk reward, the risk is pretty tight because we have a heavy duty support level here, and the reward is pretty nice. Potential reward doesn't mean you're going to be right. Here's Movado, the weekly chart. It's kind of a recovery play, so we'd probably put this in our opportunity, our contrarian. You know, this could go into a small cap. This might go into the small and mid cap, this type of play. And it's a nice heavy duty support breakout level 31.23. Okay, that's if it breaks above. All right, so that would be a new trade there. What I'm showing here for the risk reward was the trade in this part here. All right, and this is the typical type of trade we put in our contrarian. So it would break above 1884 and possibly climb up to about 31 bucks. And that would be the trade right there. Perkin-Elmer, this one's riding the 200-day line. These are nice. You have to be patient with these, but you can set up scanners and you can find stocks that are riding their 200-day line, and they just have to watch them and watch them. And you have to make sure they're good companies. Now, these are all fundamentally strong companies. I'll show you the fundamental tool we use. And then a decent probability, if everything doesn't fall apart in the company or in the economy, this thing eventually will get back up to here. 135 back up to 160. All right, then we do a fundamental screen. And here's the tool that we use. And I just showed Apple. I show Apple here. This is a fresh one. And Apple shows, I care about earnings over here. Here's earnings. Here's earnings and earnings per share. And it looks like they're going to grow earnings per share. In 2022, they grew it by 9%. 2023, they're going to grow it by 6%. I care about that. I only mess with companies that have positive earnings. If they don't have positive earnings, I usually, 99% of the time, I avoid it. And then the PE ratio. How expensive is this stock with regards to its earnings? It's trading at 26 times earnings, not bad. And then there's a bunch of other indicators in here that I'll use. And then here's the earnings growth here. Plus 34%, plus 119%, plus 100%, plus 70%. So fundamentally, Apple was just firing on all cylinders, especially when COVID hit and everyone wanted to go buy new phones and new laptops, and then checks were coming in the mail. But this is not sustainable. This is not sustainable. So now the question is what's going to happen next? How much is it going to roll over? Or if it can continue to grow at plus 6%, that's okay. I mean, you're not going to hit it out of the park, but you can still make some money. Okay, so we do the macro, that's the top level stuff. Then we do technical analysis. We're looking for specific setups of charts, technicals, fundamentals. That was what we just showed you for Apple. I want to make sure it's growing earnings. Quantitative screen. So most people don't do this, but I'm in this world of econometrics and I teach statistics. And I help with the model. Actually, I even outsource it to some other folks, but I built the model and I let them optimize it and run it for me. The use of econometric statistical mathematics to provide predictions, such as this is what the definition of factor-based quantitative analysis is. Factor-based quantitative analysis. So a model is going to tell me what's the probability that the stock will break up or break down through a particular level, kind of like a breakout. What's the probability that that stock will move a particular magnitude up or down once it breaks out? And this requires several years of education in statistics, econometric math, along with 2 or more years in developing and optimizing models, because the models need to have predictive significance. They need to be good models. And this is what I teach in class to students of how to build models and make them predictively significant. And the output looks like this. So we'll have about 3,500 stocks that we run through the model, and we get all these probabilities. And it's just one more way to screen the stocks. It's a good way to screen the stocks. And if I have like 4 or 5 stocks, they all look the same to me, and they all have good earnings growth, and the charts look the same, then this will be the tiebreaker. I'll use my quant to be the tiebreaker. All right, then technicals, that's basically the chart. That should give you all your entry signals and exit signals. So fundamentals tell you if the company's good or bad. If it's good, if they're running it well, if it's well managed, if they're growing earnings, if they're using their capital wisely. That's fundamental screen. Just because all of that's maybe true and it's a very good company does not mean that the stock is a good entry point. You can still lose money in the stock, even though it's a good company. So you have to do, that's where the technicals come in. That's where this technical scan comes in. You want to make sure the chart has a very specific setup, which gives you the highest probabilities of being right and not getting whipsawed and being wrong. So the fundamentals tell you if it's a good company. That's a prerequisite. I want it to be a good company. I want it earnings to be growing pretty fast, like plus 10%, plus 15%, plus 20%. There's plenty of companies out there that are growing at that rate. Probably a good 1,000 companies out of 7,500 companies. But the technicals tell you when to get in, when to get in and when to get out. Okay, 2 more slides and we're done. Active management style, that's what we do. We keep our portfolios diversified, but they're concentrated. We've got 25 to 28 holdings. We usually stay invested most of the time, even if the market's expensive. Okay, but you have to be nimble and keep on extracting your gains out of the market. If the market's in an uptrend, then you ride it. You ride that wave and you keep on making money until you can't. We're always proactively rotating into sectors that demonstrate strong relative strength. Okay, so if there's a lot of money flowing into industrials, then we'll be looking hard in the industrials. If a lot of money is flowing into regional banks and money center banks, we'll be looking really hard into those. And our 1,400 stocks in our list, we got all of those in our list, so we can see them very easily and we know which ones to get into. We identify fast-growing companies and strong sectors with positive earnings and good fundamentals. That kind of just summarizes what we're picking. The 4-level quantamental analysis, that's where we're doing technicals, fundamentals, and factor-based quant. We follow strict entry rules. We're buying breakouts, and we don't chase stocks that have already run. Right there. That's almost like chasing real estate, or that's like chasing anything that's going parabolic. It's never wise to chase. So we in the area of stocks, we do not chase stocks that have already run. We missed it. We're moving on. So what we're doing is we're getting into the new breakouts that are high probability, lower risk technical entry points. We follow well-defined exit rules. We let the winners run as long as possible, but we can exit fast enough to lock in gains to protect capital. Here's just one example. October 2018. We're at 80% allocated, and within 6 days, we went from 80% down to 40% allocated. We finished the year off in the positive domain, plus 18 to plus 25% gains for all of our portfolios. The benchmarks all closed in negative territory for the year. So that's an example. That just happened to be at the very end of the year. And that's how fast we moved from 80% allocated to 40% allocated. Just in 6 days, because we follow these exit rules and they just started just hitting and hitting and hitting, and it's no fun because it creates a lot of work, but it is what it is. All right, the rubber meets the road in the 2-page fact sheet. Always request a 2-page fact sheet for anyone that you're talking to. Okay, that is it, and we have gone over. And I kind of have a hard stop. Let's see. Okay, I don't see any questions. So why don't we stop there? And then if you have any more questions, then just send an email to support@qtrcapital.com. Support@qtrcapital.com. Okay, well, thank you very much for joining me in this presentation. I really appreciate it. and then just go ahead and send me an email if you have any questions. Okay, thank you and have a good day. Goodbye.